Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over ratios. I haven't done them in a while, and market conditions, and we'll see how different assets are performing against each other. Usually, when you have a certain asset outperform another asset, and I'll just give an example, platinum versus gold. When platinum outpaces gold, we're in an inflationary type environment, usually. And we can use that as signals to see if the market is ready to, quote, puke, roll over, or go down. We can also use them as signals for potential buy points or entry points when a asset is very cheap against all the other assets. So that could be a good entry point. And then we want to make sure that they're positively moving for us. So I'm going to give you my financial opinion here. We can go through the ratios together, and we can see how they're interacting with each other. So let's dive in. I've got the CRB, commodity to S&P 500. A lot of people just say commodity to stock ratio. And this still looks really good. We've broken on this pattern to the upside. It's moving a little bit sideways, which is fine. Obviously, we have no control over the actual speed of this happening, but it's still positive as we are making progress. Commodities are making progress against stocks over time, and it looks like we're just doing some sort of flagging pattern. And what I mean by that is we've got a little kind of flag pattern here. And there's the flag, if you can see it. So that's still looking good. Bigger, longer term view of this thing. We've had a massive downtrend all the way from 2008 all the way back down, and it bottomed in 2020. We've started to break out here right at 2021. We had a nice good surge higher in this ratio, and we're kind of just moving sideways in it at the current time. So everything looks good. I don't see anything wrong with commodities, and this ratio is still looking very positive on all time scales. From a monthly perspective, weekly perspective, and a daily perspective, everything is bullish that I can see. If we move into the platinum to gold ratio. Now, this ratio, when platinum outperforms gold, that usually indicates that you're in an inflationary environment. At least that's what some research over at, can't remember the school. There were some researchers doing PhDs. They came up basically saying that the market conditions when platinum outperforms gold, that you're in an environment where commodities do very well. Stocks do very poorly. When gold outperforms platinum, which means that this ratio goes lower, that usually indicates that stocks will do very well. So we were in an environment where stocks did very well all the way to the break of this pattern in 2020. November 2020, we took a nice good surge higher. We've been moving sideways ever since. But if you zoom in, we do have this massive month, which is this month, September. Platinum's done very well in relationship to other metals. So that's doing very well on the monthly candlestick basis. This is basically engulfing all these guys before it. So that's usually an indication that we could potentially go higher from a statistical standpoint. This would also be a bullish engulfing here, where it engulfs all these candlesticks before it, and we had a move higher, a surge higher out of this pattern. I think something similar is coming, and I do very much prefer platinum. Also, this ratio at 0.54 is incredibly cheap on a historical basis for platinum. Very rarely does platinum being priced half the price of gold. It's very rare. Looking at the platinum to palladium ratio on a monthly time frame, kind of a big picture view, we do have good looking candlesticks on this side in relationship to each other. So we had a nice big move higher here, small little pullback, and we're starting to put in a nice good month this month. We look at the daily candlesticks, and you can see it looks like we've got kind of a pattern that looks like this, somewhere like that. We're just kind of grinding sideways, and hopefully we can squeeze up and break this to the upside for the ratio. This ratio is out of the world cheap for platinum. Usually, platinum is multiples higher than palladium. So 2, 3, 4, 5 times multiple. The top is around 5. This one went all the way to 5.5. So that's kind of the top, but generally speaking, 2 is a pretty good, 2 or 3 is a pretty good number. And we're at 0.4. And I think this is the cheapest platinum has ever been to palladium. And people are going to ask, well, why? Why is that the case? Platinum is used in diesel catalytic converters. And since palladium was so cheap in relationship to platinum historically, they've been loading catalytic converters for gasoline engines with palladium because it usually, at least historically, it's been far cheaper than platinum. Far, far cheaper. When platinum was up in the 2000s, palladium was, $400, $500, $600. Now that's roles reversed. Platinum can substitute palladium in catalytic converters. Platinum also has a pretty bright future if we go to hydrogen. It's used in the fuel cells, hydrogen fuel cells. So platinum is of good value here in relationship to palladium. Platinum to silver ratio, I know a lot of people think that silver is the best value in the markets in terms of precious metals and in terms of assets and commodities. But this chart here tells me that platinum is even a better value than silver. Platinum at a ratio of 1 ounce of platinum can buy 46 ounces of silver. That's very cheap historically. 30 is kind of like out of this world cheap. So we are very cheap with platinum here. And I do think silver is going to do well as well. And it looks like we're trying to break to the upside of this. If we kind of zoom in, we are breaking to the upside of that move. We've kind of got perhaps a resistance line coming through here. And we're kind of squeezing up kind of this way up towards something. And it's looking pretty good for platinum. It's historically very cheap. And I do think if you look at inventories of platinum and even silver are being drawn down. So I think the price is too low. And eventually, when inventories get to critical levels, both of these metals, I think, will do very well. Looking at gold to silver ratio, big picture view, we are still at a very cheap ratio. We're at 85. We were at 96. 96 is incredibly cheap. Anything around this level here at about 96 is incredibly cheap. And there's only a few times in history that we've been this cheap. 90 in the 2020 panic, we'll call it, and then here recently. We do have a very large bearish engulfing pattern here, which means that this ratio could drop to the downside, meaning that silver is going to outperform gold. So I think silver is looking a lot better, and I think we could see a vast outperformance of silver. This ratio has moved quite dramatically here these past week or two to the downside, where silver's outperforming gold. So I very much prefer silver over gold at this juncture. The palladium to silver ratio, we've been basically chopping sideways for a very long time in this ratio. The sideways movement is basically right where we're at. We've got support. Here's our support line. There's our resistance line. And we're right coming up on resistance. And we've blown out to the downside. If I were to look at this chart and say, which way do I think it's going to go? I think silver is going to outperform palladium. I think we're going to go lower. We've got lots of selling. I call it selling pressure candlesticks, or large down candlesticks all through here. So basically, we're going to see an outperformance of silver, in my opinion, when looking at this ratio. The ratio is expensive for palladium. And palladium is more on the expensive side in relationship to all of the metals. So that's kind of the metals there, the precious metals. Dow Jones to gold ratio here. if you take a big picture view, we're kind of going back and forth at that 18-to-1 ratio. That's the same ratio roughly as the 1929 stock market bubble. I do think that this is going to compress lower over time, and I think all that it needs is a weaker dollar. Weaker dollar is going to help both stocks and gold, but I think gold's going to get helped more so as gold is priced in dollars. At least it's in dollars here. And I think we'll see a move where this compresses down where gold outperforms because of the market conditions. The market conditions are inflationary, and even under deflationary type environments, gold usually holds up much better than the Dow Jones. So here's gold to oil ratio. We've been watching this one here. We had this anomaly here where you could have bought oil for pennies on the dollar. We had this large compression lower. That's where you made all the money in oil. And now we have broken out to the downside of this resistance support line. And we're coming up and we have a retest of a breakdowns of the support line. We're retesting this. So we still, I think, can compress lower when the Strategic Petroleum Reserve release ends and we get through some of this, we'll call it slowness in the markets. May take some time, but I think the first hit will be when they stop releasing from the Strategic Reserve. The second hit is when the demand comes back worldwide. That demand could come back from lockdowns that China currently has of 300 million people. And it can also come back around the world, especially Europe, once they get through kind of the energy crisis. But right now, with that energy crisis, it's going to pull, I think, oil higher. Even if natural gas and coal is short, they're going to burn oil to stay warm, or wherever they can to generate electricity, whatever they can, they'll burn it. So I do think that this will compress back down. Historically, a very cheap ratio is anything below 10. And the cheapest we've gotten was 15, which is average. Average is 15, cheap is 30, expensive is below 10. Looking at the copper to gold ratio, this thing actually looks pretty good. It's broken the downtrend line. We've been moving sideways. It's got large up candlesticks, not too much down candlesticks. So I am inclined to say that this is going to go higher. The copper to gold ratio is usually closely tied with the 10-year yield. And right now, we've kind of dilly-dallied at this support line. We never broke it out of it, and we've come on back with this pullback here. But it's been holding on recently. And again, I'm inclined to say that this could potentially go higher by looking at the candlestick patterns in here. So it still looks all right. Uranium, looking at uranium to silver, we're going to do kind of big picture view on these. This looks excellent for uranium to outperform. Uranium looks really good there. We've got uranium to S&P 500. This is looking like it's just stuck at a resistance line, and we could potentially break to the upside for a very big move in uranium. Uranium to gold looks good. We've got nice, good momentum coming on up here. We are at a sticky point right at that resistance line, and then we just have to break to the upside. So it's just at a sticky point right now. Uranium to crude oil, this guy is breaking to the upside. It looks good for a uranium outperformance. So that looks good. And then uranium versus copper, we're right at that resistance line. So we're basically at the resistance line for all of these. And this looks like uranium could outperform copper. So uranium could outperform every single commodity that's out there. The momentum's to the upside. We're just at these resistance sticky points at this time. And then looking at the Baltic Dry Index, we're very low. It is heading higher here recently, but we're still at a very low level. Last time the Baltic Dry Index really took off in 02, and it took off in 06, kind of a late stage performer. I think this is going to also be similar to that. I think the market conditions right now, with energy as high as it is, could be delaying the move of the Baltic Dry Index. Not too much can go down with an energy crisis, although dry bulk shipping does ship a lot of coal. So that's what we're seeing there. If we were to look at some of these other types of ratios and money supply metrics, this is just the United States Consumer Price Index. You can see it kind of moving sideways here. And I think that's due to the release of the Strategic Petroleum Reserve. And whenever you see a deflationary real estate collapse from loans collapsing, you can see a pullback there. That's what that little pullback is. So we can watch this, but right now it's just moving sideways. The M1 money stock had an absolute blast off during this crisis, and then it also went up dramatically all the way till just recently, the beginning of this year. And it's just starting to move sideways, starting just to cool off. So that's what we have for M1 money stock. The United States housing starts is right at that support level. We want to see this continue higher. This is one of the drivers I watch as a metric. This is kind of the uptrend line here. We can still go a little bit lower, down to maybe 1.4 million, 1.39, and still be in an uptrend. But if this breaks out to the downside and stays going lower, that is a cause for concern, because historically, when the housing market has, I should say, when housing starts has contracted like that, we have seen a recession or crash, like a bigger one, not just a teeny one. So that's something we want to watch. The data does get released 9/20, September 20th. Inflation rates are still being resilient. We've got this downtrend line. We've been playing with a breakout in it. Are we going to break to the upside? We'll find out. We've basically are sitting on that support line or resistance line, depending on how you look at it. If we move on higher, it's a clear break. And they're probably trying to do, the Federal Reserve is trying to stick save this where we don't break to the upside. Then we've got the producer price index in relationship to the consumer price index. We are pulling back on it. We hit our head on this resistance area here. And I think that's from the Strategic Petroleum Reserve releases. We've had the Freeport LNG facility go down. So I'm not 100% sure, or I'm not 100% convinced, I should say. I'm not 100% convinced that this is going to be sustaining. I think we'll pull back for a little while, and then I'm going to look to see what oil and natural gas do. If they go higher this winter, then it's off to the races again. But if they continue to raise rates and they continue to put that pressure on, this is the federal funds rate. This is what I'm talking about here. If they continue to raise these rates and they just go ballistic to the upside here at the end of this year, we'll have to see how that impacts the housing market. Because if we lose the housing market, that's when you can lose some of these investments. That's where things start to roll over and crash. And I know some people say, well, it's the thesis. The thesis is if the housing starts go lower, that we should be looking to exit our positions for a little while and potentially hide out even in bonds, because bonds have been getting slaughtered. But here's the thing. Usually in a deflationary type crash, you would see bonds, the bond yields start to go lower and bond prices start to go higher. We're not seeing that movement, which makes me say, all right, I'm going to sit in where I'm at. That's the 10-year yield. We are still launching higher in the 10-year yield. So the people who position in bonds and the banks and all these guys, they are not selling off yet. They're maintaining higher bond prices. And same with the 30-year yield. It is still going on higher. So again, I know a lot of people in the markets are afraid, but the data shows that we should stay long inflation assets, just like all the smart money in the world is. They're selling bonds. So money is rotating out of bonds. We can see it in the yield prices going higher. It does look good for the inflationary movements, the inflationary data that we have, and like platinum to gold ratio. It looks like platinum wants to go higher. That's another positive signal that we're still in that type of environment. We've got copper to gold ratio, which is also going it's basically going flat. It's broken its downtrend, which is also a positive indication that we could potentially have more inflation. Inflation is usually synonymous with a strong economy, usually, because that's how money gets into the system. But we've had this large push of inflation into the system from stimulus, and it is playing with all of the numbers, I think, and all the leading indicators. That's what makes this market condition a little bit more difficult, is because we've had external money come into the system, and I think is playing with all of these numbers. So that's what I've got for today, guys. If you guys like this type of analysis, definitely subscribe to the channel. Click the thumb up button. If you guys want to become members of the finding-value.com, that is something that you could be joining. We do have a platinum question and answer session, 7 a.m. Mountain Standard Time. It's right when I release this video. We do have that question and answer session. If you miss the session, that's okay. You can always watch the recording of the session. So that's what we've got for today. And that's all I've got. So we'll catch you next time. This is Finding Value.